global stocks this week are facing what can be said as one of the worst weeks since the pandemic-induced turmoil of 2020. Stocks tumbled on Wall Street and back home as well, as fears gripped the investors' imagination that the world's fragile economy may buckle under higher interest rates. Back home, despite a smart beginning in the morning trade, the benchmark Sensex failed to hold on to the gains and plummeted to 1,045 points to settle at 51,495 levels, the lowest in over 12 months. Nifty plunged to 330 points, or 2.1%, to close at 15,360. The session this morning, Friday, witnessed Nifty seeing a gap down start to start the day at 15,272 levels, which is minus 0.57%. Stocks fell in Asia on Friday amidst fears of an economic downturn as monetary policy tightens to fight high inflation. You may argue that this all is known, sir. We too are seeing the same figures as you're saying, so we know what you're pointing us to. Fair enough. I'll ask you a series of questions and we'll ask you to write a yes or a no, and if I may please request you to grab a pen and a paper, okay? So go ahead, please do this for me. Just write yes, I knew this, or no, this is something that I've learned from Informed Investor today, okay? Shall we start? All right. Do you realize these inflationary concerns are not permanent? These concerns are not new, and surely not the first or the last time that we are seeing these govern the market movements. Do you know this? I hope you got this. As the discussion is Fed and the US, I'll ask you this. Do you know that since 1950 there have been 12 instances of interest rate hikes in the US? S&P has delivered positive returns in 10 out of those 12 instances. Only one instance of negative returns. Now let's see this for India. Did you know since 2000 there have been 4 interest rate hikes by the RBI, and Nifty has delivered positive returns in all of those instances? Did you know that? Do you know in all cases average GDP growth over the period of the interest rate hike is higher, or at least the same, than the GDP growth at the start of the hiking cycle? Did you know that the earnings growth outlook for FY23, which is expected, is likely to be 18% positive? Well, this is considering the EPS to be about 860. And do you know that the earnings are further expected to be growing at about 13% in FY24, which is the expected number, considering the EPS of about 970 for Nifty? Now ask this vital question, being an investor in India. What are the chances of India doing better than that on the inflation front? It is not clear how soon the Ukraine war situation will improve and ease global supply constraints, but monetary policy is being tightened quite sharply in the US and in other advanced countries. Hence, on balance, the external pressures driving the Indian inflation are likely to weaken in the months ahead. Well, on the domestic front, assuming a normal monsoon, no new supply side disruptions or duty increases on fuel are expected to exacerbate inflationary pressures. For its part, RBI is likely to raise the policy rate again and take further measures to squeeze the liquidity. Hence, inflation may indeed decline to less than 6%, though the 4% target seems beyond reach. Now, the most important question then is, what about growth? What about it? Following the unprecedented 6.6% contraction in 2020-2021, triggered by the pandemic, growth bounced back to 8.7% in 2021-2022. Views have now converged that GDP will grow at about 7 to 7.5% in 2022-2023. RBI has maintained its growth forecast at 7.2%. However, a growth rate of 7% is way above the pre-pandemic growth of 3.7% in 2019 and 20 that we witnessed, and also higher than the trend growth of 6.6% achieved during the 5 years preceding the pandemic. To the next and the most suited question, would such growth be sustainable? We are probably at the cusp of a new private investment cycle. Corporates use their surpluses during the past 2 years to reduce the debt rather than invest in creating the new capacities. Hence, the corporate sector is now less leveraged, while rising capacity utilization is signaling that this is indeed the time to invest in the new capacity. The investment rate has accordingly started rising and is higher today at 33% than what it was in 2019 and 2020. So this new investment cycle could be powered by the production-linked investment scheme, which has proven very popular and may be expanded further. Another important development that could significantly boost investment over the medium term is the US-led Indo-Pacific Economic Framework, which is the IPEF, just launched in May, with India as one of the 13 founding members. If IPEF takes off and India can negotiate early and successfully using domain experts and not just bureaucrats to secure its national interests, this could be a game changer for India, enabling high growth led by exports and investments. One last bit from the informed investor team. It's true that inflation concerns continue to grip the markets, and recent rising oil and gas prices are adding to the worries. But be rest assured, the underlying fundamentals of the US and Indian economy are intact. In spite of inflationary concerns, corporates' earnings look decent. Jobs markets look strong. Household incomes are strong. And more important, consumer demand looks very strong. So only a few investors, and that's a fair average that I'm taking, are taking advantage of the recent volatility by building positions in fundamentally strong, great businesses that are currently available at a significant discount to the true intrinsic value. So only few investors making the most of such opportunities has very little to do with recessions, depressions, war, financial crisis, political crisis, rising interest rates, inflation, stagflation, global pandemic of most adverse microeconomic environments. The stock markets have seen all of these, what I just mentioned. And yet, we see only a few people making 10x, 100x from investing, even under such diverse and challenging concerns. Remember, it is not adverse macro events that derail the compounding, but it is the investors' reactions to these adverse situations. A car manufacturer will continue to make more cars and sell them at higher prices. A paints company will continue to ride the infra theme and have more of their colors on every wall that gets built. An NBFC will continue to fuel the ambitions of a growing aspirational middle class in India. And businesses will continue to deliver 10x, 100x, even from these situations leading up to the next decade or so. But it's your behavior that will derail your progress and force you to sit on the sidelines while the world around and a handful of investors continue to move on and create wealth for themselves. So we hope the DITM today helped you in some sense. This is Sanjeev Anand signing off from the DITM desk at Informed Investor. See you soon.